Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app. We begin this hour with stocks edging lower as AI concerns weigh on Wall Street. Yardeni of Yardeni Research remains bullish. She writes the following: investors are rotating among sectors of the stock market rather than moving from stocks to cash. The bull market should remain strong as it broadens. Ed joins us now for more. And Ed, I've got to pick up on the question that Lisa and I were talking about. Ed, sure. The rotation, is it more than just that now? Is it becoming just a little bit more defensive?
Well, I think, if you played day by day, it certainly felt like it last week, as you said. I think some of this is just AI fatigue. People are just totally tired of the AI concept. They don't know whether they're coming or going with it. They don't know whether it's going to be wildly profitable or not. And I think another thing that's entered here is, Elon Musk has been talking about how deflationary the combination of AI and robotics is going to be. And so we've got all that happening. And as you folks were saying, the geopolitical situation is also quite volatile. We've got a situation in Japan where the government wants to stimulate and have a larger deficit, and yet the Bank of Japan is tightening. And then, by the way, let's not forget there's a possibility here of a war between the United States and Iran. And that could obviously push oil prices higher. But the bond market's kind of taking it as maybe it's time to look for a safe haven from all these various concerns.
So, Ed, let's talk about the havens and where we're fleeing. So the money is leaving tech. The Nasdaq's down by about 1% this morning. The money is going into staples, into utilities. Those two sectors are all-time highs. Right. Where do you think the bigger risk is at the moment? Where people are leaving or where they're going to?
Well, at this point, I think the uncertainty in AI suggests that that entire trade is going to remain challenging. And meanwhile, I think investors will continue to go basically from the virtual theme to the physical theme. They're getting confused with all the digital technology, and they're going back to the old-fashioned analog world, the physical world. And that means materials and energy and, as you said, consumer staples. I think financials is one area where it's getting overdone. I think they're clearly the large banks and even the regional banks are going to do just fine in this environment. And I think healthcare, which was a laggard last year, is also an area that's going to clearly benefit from AI technology. I don't see a situation where AI robots do surgery, though. Elon Musk has been talking about that as well.
Is there a contradiction, Ed, in the idea of materials, metals, commodities, the idea of the physical world continuing to gain favor, and also liking government bonds that are somehow implying inflation remains subdued?
Well, I think, Lisa, the thing that's important to recognize is things do change. And in our world, their wealth has increased rather dramatically. There's a lot of wealth that needs to be, that creates investment demand. And a lot of it does want to be diversified. And so it's perverse. As the stock market's gone up, people have felt a little bit more anxious about it and said, well, maybe it's time to rebalance. So that's why I recommended rebalancing in early December of last year. I actually said it's time to underweight the Magnificent Seven because I felt that there was just too much uncertainty related to their capital spending, their rate of return, the arms race that they were engaging in. And I did, for the first time in many years, suggest maybe it's time to look overseas. Maybe there's, I don't know, safe havens, but there's cheaper havens overseas. And that worked out very well last year. I only jumped onto it in December, but I think it's going to continue to jump to do well.
Are international stocks a better diversifier than U.S. bonds?
Well, I'm not going to answer your question with either or. I think gold has been the really good diversifier for the stock market. If you put the S&P 500 on the same chart as the price of gold, same scale, you'll see that they're inversely related on a cyclical basis. So it's really gold is a very good diversifier. It's inversely correlated with stocks, but the trends are the same. So if I'm right, and we're still very much in a bull market in stocks, just rebalancing, diversification is going to benefit gold. But I think it's also, we're seeing here, it's benefiting bonds and it's benefiting emerging markets. Look, the MSCI US got to be 65% of the market cap of the global MSCI, and that's it's hard to overweight something that's already so overweight, and so that's a good reason for diversifying globally. And a similar story can be told about information technology and communication services. They got to 45% of the market cap of the S&P 500, and maybe that's it for a while. And we are seeing rebalancing. So I think the rebalancing trade is a sensible one. I would stick with it.
So, Ed, what's the argument for the index, for the S&P, for the market cap S&P 500? What's the bull case?
Earnings have been phenomenal, and they're going to be at when all the data comes in for the fourth quarter earnings reporting season, it's going to be at an all-time record high. I thought that we're going to get something like $310 a share for the S&P 500 this year, but the analysts are already up to about almost $320 a share, and then for next year I thought $350, and the analysts are already talking about $360. So the analysts are getting pretty whipped up about the outlook for earnings, and it's not just technology, which I think will continue to be a very profitable area, notwithstanding the concerns about return on capital. But it's broader than that, and not only that, but I think the fact that revenues of the S&P 500 are all-time record high speaks to the fact that the global economy is doing remarkably well. I mean, it's really quite amazing given the stress tests that the global economy had with the tariffs last year.
Ed, you nailed it when you called this the Roaring 2020s. We're already in 2026. Does it still feel like the Roaring 20s to you, or does it feel like it's kind of entering its later stages?
Well, I don't think so. I'm already starting to think that, if this works out, I'll talk about the Roaring 2030s. The 2030s are going to be a little bit tougher because the 1930s were really just plain ugly. But let's stay on the decade that we have right now. And as you said, we've got a few more years into the Roaring 2020s. I don't think that it's showing signs of fatigue. I think the Roaring 2020s is still very much intact. We've got the economy doing extremely well, real GDP all-time record high, consumption spending all-time record high, capital spending all-time record high, stock market not too long ago was at an all-time record high, and I think now is just a pullback. So I think it's still very much the Roaring 2020s, and it's earnings-led, which is a good way to keep it going. If it was all valuation, I'd be concerned, but I think the fact that earnings are validating this bull market, that's a good thing.
Stay with us. More Bloomberg surveillance coming up after this. Tensions emerging between Anthropic and the Trump administration. Defense Secretary Pete Hegseth considering cutting ties with the firm and deeming it a, quote, supply chain risk over disagreements on using its AI tool, Cloud. Terry Haines of Pangaea Policy joins us now for more. Terry, do we have a deep understanding of the consequences if you get on the wrong side of this administration and you're a tech firm?
Welcome to the fabulous world of defense contracting, John, and welcome Anthropic. More importantly, this strikes me as being about two things. One is it's about who decides to make the rules to utilize the thing that is being provided to the Defense Department, and the other is a supply chain issue. I'm not competent to talk about the supply chain issue, but I can talk about the first issue all day. And the bottom line is that if you want your thing to be used by the Defense Department, no matter what the thing is, and you've contracted to provide the thing, then you don't get to decide how the Defense Department uses it. it might be nice to think or pretend otherwise, but that's just not the way that's going to operate. So, seems to me Anthropic has more of a decision to make here than the Defense Department does.
It felt a little bit, Terry, like Anthropic's becoming or trying to become the anti-Palantir, and they're trying to take lessons to some of the controversy that Palantir has invited elsewhere. Is there another way to read this?
I think it's a savvy comment, Lisa. It seems to me that a lot of this, based on your conversation and what Tyler said and your own reporting at Bloomberg, has been a lot about internal struggles at Anthropic to define itself more than anything else. And as I say, I think they're crashing up against the reality of being a major vendor to the United States government.
It feels like there is a lot of angst within the walls of Anthropic. We're hearing about people quitting to go write poetry in the UK countryside. But at the same time, there is a sort of an angst developing in Washington, D.C. about how they regulate some of these technologies, given that, A, we don't understand fully how they're going to iterate, what they're going to disrupt, and what the implication is going to be for the labor market. I mean, how much does Bernie Sanders have company on the far right of the spectrum based on some of the expectations of what AI could do?
Well, a couple of things. Bernie Sanders gets treated as a canary in the coal mine, a lot of times. And at the same time, Bernie Sanders has no legislative accomplishments. Bernie Sanders is somebody who, generally agitates and points in a particular direction. The Democratic Party has got a problem here because they're going to have to figure out whether the Sanders vision or somebody else's vision, a more business-friendly, centric direction, is going to be the way that they go. That's been a perpetual problem since Sanders has been a major voice in the party. It's kind of on the administration side. It's been very clear. They consider AI to be a core matter of national security. We need to fight and win on at all costs, and they don't particularly care about the consequences. And that's very similar, I think, to the old Manhattan Project days. Kind of damn the torpedoes. We're going to go forward and deal with this and figure it out because we've got existential problems if we lose.
Terry, until their jobs are threatened, because this is a democracy. TikTok was once a national security threat, and then their jobs were threatened, and quickly their minds started to change down in Washington, D.C. Now, I want to understand from you, a man who has lived and breathed Washington for decades, what would happen and how they'd respond if the Microsoft AI chief is right and what he told the FT materializes, that in the next 12 to 18 months, as quickly as that, we can automate basically all white-collar jobs. And you started to see the unemployment rate go through 5 and approach 6, and people leaving university, like right now, they can't get jobs. Terry, how would they respond down in Washington?
Well, I think two things, John. One is that putting aside the self-promotion of the Microsoft AI guy, Washington has two reactions. One is to treat with great skepticism whatever the perceived crisis of the moment is in the markets. What Washington sees, frankly, is the longer game, where there have been huge upticks in the markets, and now you see a little bit of wobble. Washington saw a wobble in tech stocks last November for different reasons, but it did. So they'll let that play out a little bit. Firstly, secondly, it's going to get a whole lot more worse. A whole lot worse before Washington reacts at all. And then the playbook always is, what I view as kind of scraps, retraining programs and the like, that didn't really move the employment needle a lot in the 90s for blue collar jobs. But Washington, I will tell you, generally speaking, particularly in an election year, is not going to shed a single tear for white collar jobs going away. That's not beneficial to either party, and they will look at it as an outlier compared to the kind of things that happened over the last half century.
Stay with us. More Bloomberg surveillance coming up after this.
AI disruption rippling through markets, with the Nasdaq 100 coming off 3 consecutive weeks of declines. Momei Q of PSP Growth writing, the reasons causing the sell-off seems to be at odds with each other. Painting all tech with a broad brush is not rational. Momei joins us now for more. Momei, welcome to the program. Let's just take it from the top once again and think about what's been announced over the past few weeks. A massive amount of capex intentions across just 4 companies, and yet Nvidia started to trade softer over the past 2 consecutive weeks. Momei, what do you think is behind that? Why are we seeing a decoupling from one of the biggest picks and shovels and the capex intentions of some of the biggest companies on the planet?
Yeah, good morning. There's definitely a lot of fears in the market right now, and not everything's really rational. So if you look at some of the main reasons for the sell-offs last week, in the weeks prior, I think some of them are actually at odds with one another. You're seeing softness in some of the Mag 7 due to the massive spending in CapEx, and the concern that maybe those investments are not going to make a return. But yet at the same time, software stocks are being hit because of the exact AI disruption that's happening, that might threaten them. So in my head, those two are actually at odds with one another, which makes me think that there's a broad fear in the market that's not very rational. So I think if you look at NVIDIA with the other bigger companies, there's probably a lot of not rationality in those either, in that people might think NVIDIA has been overpriced. People are already thinking the promises have been made too high. So as of now, NVIDIA can beat earnings, they can do everything right, but yet the expectations are so high that the market is not being very rational right now.
Momei, let's take those 2 extremes. Either it's going to disrupt everything and crush a lot, or it's a waste of money. Do you pick one or the other, or is there something in between?
I think it's something in between. I think one of the fears that's causing all this fear in the market is I do think there's going to be quite a few losers in the AI race. You're not going to have every company become the next big giant in AI, but I do think painting everything with a broad brush is also not rational. If you look at sectors that have more verticalized knowledge, that have more verticalized processes, those are not going to be disrupted the same way as the rest of the market. For example, we see that Procore and Autodesk has been hit pretty hard in the construction software stock. We own 2 construction tech companies in our portfolio, OpenSpace and HiArc. They're doing quite well. They're very resilient. We're seeing the customers, they have general contractors on the job sites. Those general contractors working every day is not going to all of a sudden wake up and find a way to find engineering talent to work with OpenAI and Anthropic and build their own AI tools. So we think for some of those industries, you're going to be a little more shielded than the rest of the market, and painting them with a broad brush is not rational.
Momei, how do you know, though, what's rational and what's not rational? On one hand, you've got a lot of people talking about what you're saying, who has a moat around them that can be protected from AI disruption. And then you've got an AI safety researcher over at Anthropic quitting and saying that the world is in peril and going to write poetry. Which is it?
That's $1 million question. And I think it's going to shake out differently in different parts of the sector. Some sectors, as I mentioned, will be more resilient, and others with more simpler workflows, like you see higher disruption in, say, CRM and the legal space, because those are more structured data. Those are more prone to disruption with large language models. I think on the safety side, that's an interesting trend that we're seeing too. In my head, it's actually a maturity of the market, the maturity that the market thinks AI is going to be more mainstream than before. If something is simply experimental, you're not even going to have AI researchers at the companies, never mind safety researchers that are ringing alarm bells that something needs to be done about the guardrails. So I think it's good that we're paying more attention to safety and security and regulations. And I think those are both the public markets and the private markets, those are the companies that's going to show more resilience as well in this market.
We're seeing more of a focus on safety in the United States in particular, also in Europe. How much is this a reason that people are going toward Asia tech, where it seems like there is more of an emphasis on growth and less on the potential constraints?
I think it's definitely part of the reason. And I think you're definitely seeing more activity in Asia now, right? Like we're seeing all this activity within India, investing all these dollars in AI. So I think safety is one reason, but I also think it's momentum. You've seen a lot of activity already from the US and the Europe markets investing in mainstream AI, and Asia is now all of a sudden announcing that you're investing heavily in mainstream AI. So I think it's both the safety piece as well as the momentum piece that we're seeing.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.